see, I'm going to kick off the first talk of today. I'm Profit, for those who don't know me. I'm the co-founder of MetaDAO. And yeah, this talk is geared towards founders, particularly early stage founders in crypto. So if you're not one, I think you'll still find it interesting, which is how a token can help you win in this crypto game that we play in. And yeah, so I think the main goal of a token, other than liquidity, is to align your community with your success. And historically, if you look at some of the most successful projects in crypto, a token has been an unfair advantage for them. Ethereum is one of the earliest examples of this, where they did this big chunky ICO for 85% of the supply. All these people bought ETH. I think it was like 20,000 people in the ICO, or wallets at least. And then, it's still like all these people bought ETH, and then as ETH went up, made a lot of money. This bag bias is what I believe a factor as to why Ethereum is still dominant on stablecoin market cap, on number of developers, on some other metrics too, despite being such a bad product relative to Solana, right? It's so slow, it's so expensive. I came from ETH, so I know this, and yet it's still is a credible player in this game. And I think a big reason for that is just a lot of people own ETH. A lot of people wanted Ethereum to win. And then Jupiter recently, Meow talked about how during Jupiter or before Jupiter, they pivoted from being a product-centric company to a community-centric project. And that was how they thought about Jupiter. That's also how they thought about their CAT program and their alignment transparency system. And because of that, partially at least because of that, of course, the product contributed to it, but Jupiter is the biggest project in Solana as measured by market cap today. And then Hyperliquid is the recent example where did this big chunky unconventional airdrop of 31% with no private investors. After that, perp volume 6x on the platform. And then Mega ETH is another more early example where they were pretty low on mindshare, then did a echo round, sold tokens to about 3,000 people, and after that their Kaido mindshare 15x'd. I think with all of these, the thing you have to think about as a founder, if you're going to go compete with Jupiter, if you're going to go compete with Hyperliquid, you don't just have to compete on product, right? If you're competing with Hyperliquid, say you're the founder of Lighter, because it's not just about the product. It's going to be every time you talk about your product on Twitter, you're going to have a bunch of .hls in the comment section being this sucks, just use Hyperliquid. And same with Jupiter and Mega ETH, you can see all the Mega ETH bulls ragging on Monad, and then obviously Ethereum and Solana has had a long history of this. I think a token is pretty critical of that because it actually gives financial upside in for people in your project. And then to just hammer this point down, imagine Bitcoin without BTC. Obviously it's kind of hard to because Bitcoin is BTC, it's built for currency, but I guess just imagine if the bag bias didn't exist. Imagine if it was just this abstract idea of a currency and people didn't actually hold it. Would it have been so? Would people have spread it so much? Probably not. Or Helium without HNT, Solana without Sol, and the Mammoths. It's clear that tokens give you an advantage when done right. And then the other thing to point out is that low float high FDV, which is the current meta, right? It's not the exception. It's the norm among projects. Is not great at achieving this community alignment, right? The thing to notice is that yes, most projects launch low float high FDV, but if you look at the most successful projects, you just pull up CoinGecko and go through the top 10, 20, 50, 100 projects, they're disproportionately not projects like that. Canonically, the biggest two, Bitcoin and Ethereum, are very not like that. One reason for this is, this is the way that most low float high FDV launches work. This is the pie chart. You have your team, your airdrop farmers. That's how tokens get allocated. You have private investors, And these are all structural sellers, right? Like, they all have very low cost bases. In the case of the team and the airdrop farmers, the cost basis is zero, and relative to the current price. And what happens if you have like a low cost basis? Like if you're up 100x, you tend to sell some of that. And then you also, it's not just about that they're structural sellers. It's that like the TGE is this big event that attracts all this attention to you, and a lot of people are just like bidding on sexes on first day listings. Like if you, and this is what happens 9 out of 10 times, and this is not just like my opinion. Like you can go through all the Binance listings over the last year, or like all of the sex listings over the last year, and you just go through each token and pull it up on CoinMarketCap. Like this is what you're going to see, and that's a problem because yeah, if what we're trying to achieve is community alignment, people don't tend to like things as much to lose the money, right? If you lose 90% of your money by like believing in something, like that kind of sucks, and you tend to like that thing less, and so this kind of like kills your community in a way. And yeah, so we built a launchpad that we think is better and actually allows you to leverage the power of token to like strengthen your community. And yeah, so it's a pretty simple system. How it works is you have an uncapped ICO over 7 days. So over 7 days, people just put in USDC, and at the end of 7 days, the tokens are just sent out to everyone proportional to how much USDC they put in. And then 10% of the USDC that's raised is then used to provide liquidity on like a Radium pool, so that people get liquidity. And then the remaining 90% of the USDC and also the ability to mint new tokens is given to a Futarchy DAO. So this is not a Futarchy talk, but yeah, just think of it as like a DAO that works, and there's a lot of social proof that it works. And yeah, so this is everything. There's no other components really to the system. And why this is good? Well, we can go through point by point. So I said uncapped ICO. So for the uncapped part, if you have an uncapped sale, so like people can put as much money as they want. What that means is that like on day 2, there's not necessarily more demand, right? If you want to bid the token, you bid it in the primary market. In that ICO, you don't bid it on day 2, and so like there's not an incentive to just like buy in the ICO and then flip right after, because the token is probably not going to go up a bunch right after you list. And so really the reason to participate in ICO is because you believe in the project for the long term, as opposed to trying to flip a token. Versus like if it's capped, like yeah, if you were selling like $100,000 of token and there's like $1 million worth of demand, like probably investors will just want to get into that sale so they can flip it on day 2. And then yeah, the second part, ICO. So that means that everyone who's getting in, the cost basis, their cost basis is the price at which you launch, and which means that like yeah, there's not as much structural sell pressure because yeah, like they have the allocation that they want. They don't have more than the allocation they want. And then yeah, so because you start the liquidity at the price of the ICO, that means at the very start, before you've minted any new tokens, the FTV of the project, like the amount of tokens in circulation multiplied by the price, or the like market cap, which are equivalent in this case, is just equal to the funds raised. So if you raise 200K, your FTV is 200K, which means that if you're like a legitimate project, like and you prove this over time, you're kind of like begging to go up, right? Because legitimate projects in crypto that have like a real shot of building something of value and distributing that value don't trade at 200K over time. And then yeah, backed by Futarchy is the last part. And yeah, I'm not going to go into exactly how it works, but like if you just take the abstraction that Futarchy works, it's like a good governance mechanism. It means that token holders have some belief that they're not going to get rugged, or like are much less likely to, because the team can't just walk off with the money. They have to actually go through governance, and so they should be willing to put more money in, as opposed to if you could just walk off with the money. And yeah, so those are the 4 points. And yeah, so the case study, we've done one project on the launchpad. It was Mountain Capital, so it's the first futurity governed investment fund. We expected it to raise like pretty much from our community, so we expected like $1 million from like 200 wallets. Ended up raising almost 5.8 million from 1,900 wallets. So that was cool. And yeah, so this fund now exists, and like all this capital is actually controlled on chain by futurity. And yeah, so that's kind of the system. I'm now going to address like some of the skepticisms we get from founders, and why. I mean, some of them are valid, but also like potentially less valid than at first glance. So the first thing is like people ask like, I want to raise external VC funding, right? Like ICOs are cool, but like I want to get some flashy VC invested in me, or like some I want to specifically there's like a company that I want to invest. I want to get them aligned, like strategic, and the question is like, can you do that within the system? So MetaDAO works like this. Like our project, we have a liquid token. It's existed since day one, and Paradigm, along with other investors, but yeah, like tier 1 VC invested through this mechanism, and then yeah, so one of the best VC funds, and then Thea, which is one of the best liquid funds in crypto, if you know, you know, also created a proposal to the DAO to buy the native token. So I think that kind of proves like if you can raise VC funding with this model after the fact. And the other question is like, will it be seen as a rugger if the project doesn't work? Because it's like, anyone can kind of buy this token. And yeah, I mean, it's obviously not ideal if your project doesn't succeed for like many reasons, but like, yeah, I mean, I don't think here it's that different than if a startup doesn't succeed because there's no pre-mine. If you liquidate the treasury, like say you raise 2 million, it existed for a year, just realizing like, hey, this product isn't getting PMF, we spent $1 million. There's no other tokens in existence other than the ICO tokens, and so everyone would just get back 50 cents on the dollar for what they put in, which is like exactly what happens in startups when they return capital. So yeah, it kind of works like the preferred share liquidation rates of startups. And then this is actually, so a lot of people I know believe like, oh, there's all these people who are gonna be like, oh, you're a rugger, like token go down. So MetaDAO's token has gone up and down many times. Like recently we went, we've gone down a lot a few times. This is actually the only time someone has ever complained to me about a token go down. And I think the reason why that is, and like why most projects have this problem, is because like it really just depends on like if you're priced sensitively. I mean, if you're priced reasonably, like you are not going to get as many retards on your cap table. If you're priced at like $1 billion pre-product, you're going to get a lot of fucking retards on your cap table, and they are going to be like complaining if the token goes down because they don't understand how markets work. And yeah, so I think like here you get higher quality people on your proverbial cap table. And then yeah, the other question is like, are you giving up control? So I think in theory, yes, right? Like anyone in theory could create proposals to this DAO. But in practice, like people put money in because they believe in you. They believe in what you're building. And they're probably not going to say like, oh, day one, we actually don't believe in this founder anymore. Like, time to back up. And then we're also working on a system called optimistic governance, which would essentially allow you to enqueue transactions as the founder that by default go through after say like 3 days or a week. But the community could like veto, right? Like if you raise a proposal, just like dig Dollar Treasury, send it to yourself so you can go on like Bahamas vacation, like that would probably be a proposal that gets vetoed. And then yeah, what's the legal structure? And this is we also follow this, which is a Marshall Islands DAO LLC. The operating agreement was written by Gabe Shapiro, the former GC at Delphi. And then if we're US based, like we are, you have a separate operation, or like you can have a separate operational entity so you avoid legal nexusing the Marshall Islands entity in the US. This is at least what Paradigm's lawyers told us to do. And then yeah, so like wrapping up, just like I think if you're a crypto founder, you should heavily consider this model just as some nice social proof. This is Brian Smith, the CEO of Cheeto, and yeah, I'm just going to read out what he said, which is that fiat-governed ICOs are the least extractive capital formation model to ever exist in crypto. Expect $500 million invested this way during 2025 this year as the model goes mainstream. And then right after the Mountain Capital launch, he said Mountain raised $5.8 million through a fiat ICO as the first project. If you are a pre-seed team, you should seriously consider this before taking outside capital. Once token docs are signed, you get stuck in the high FTV, low flow playbook. So yeah, that's kind of the pitch. And if you are an early stage founder, please reach out to me here. This is on Twitter and Telegram. So